Welcome to Retail Retold, the stories behind how that store landed in your neighborhood. I'm Chris Ressa, in conversation with the people and stories shaping retail and real estate. Brought to you by DLC.
Welcome to Retail Retold, everyone. Joined us today. Today, I'm here with Jordan Hearin. Jordan is the Chief Product Officer at ID Plans. Jordan, welcome to the show.
Chris, great to be back. Great to be back. Thank you for having me.
Love having you on. Jordan, tell us a little bit more about you, who you are, and who ID Plans is, and what ID Plans does.
Yeah, for sure. So obviously my name is Jordan. I've been working in technology and building technology products for just over a decade. My experience in commercial real estate sort of fell into it about 6, 7 years ago, and consider myself a raving fan. I spend all of my time reading and researching, hanging out with guys like you, Chris, and others. And my core focus in my day job, but also my personal life, is to bridge the gap between technology, cutting edge innovation, with constantly changes and competitiveness of commercial real estate. So I try to serve as the strategic leader at ID Plans, but also serve to add value to folks in commercial real estate, being the technology liaison and being able to build products that are truly value add and actually solve problems.
Okay, that's a lot. We'll dig into that. Tell
Great.
me, what is ID Plans?
ID Plans, funny enough, we are celebrating our 25th year anniversary in June. So we're very excited about that. We got started back in
Congrats.
1999. Thank you so much. With a simple product that was really hard to do. We organized the capturing of relevant information at outdoor shopping malls all across the country, and we put those into booklets and then ship them across to property managers and asset managers, giving them a point of reference at their property. And so let me be a little clear. We deployed field teams to shopping centers all across the country, capturing information like every single HVAC unit and what the metadata or the manufacturer, the tonnage, all that kind of stuff, the electric meters, even more granular information like wire tracking and waste. Basically, every single piece of information a property manager could ever know, the property manager fever dream of information, we captured and distilled into a really clear booklet. Well, that progressed over the years into a digital application, what we call Remote Property Manager, or RPM. RPM now became this really foundational data layer that allows guys like myself and our engineering team to build robust software applications that live on top of that data set. So we have over 2 billion square feet, and for every square foot, there's relevant information like all those HVACs and waste receptacles and utility meters and lighting fixtures, et cetera, et cetera. And so now we get to build our inspection platform, our work order platform, our robust reporting and business intelligence, and most lately our tenant portal that all interacts natively with that information. So our goal is to centralize all departments in commercial real estate into one collaborative application or one collaborative data set, and utilize visuals to help simplify complex data, create efficiency, really bridging the NOI and all the really good financial stuff. And honestly, Chris, creating a really positive experience for the property managers, but frankly, the tenants too.
Got it. Okay. This centralization word, I think, is a word a lot of tech people use. So it's a compelling word. It's very hard to do, though, to get everything centralized, especially as all these companies have legacy tech stacks,
Right.
and contracts. It's challenging to do. We'll probably dig into that a little bit, but appreciate the insight on who ID Plans is, who Jordan is. Your customers are typically landlords.
Oftentimes landlords, property owners, but lately third party management and retailers as well.
Okay. And of all these customers, what What are some of the key themes you keep hearing from your customers right now? Give it currently.
Yeah. So I think in another way to phrase it, Chris, why do people come back to ID plans, or what is the biggest driving force on why someone would consider ID plans as a solution? I think it's twofold. I think the original value prop way back 25 years ago is still valid today. The nature of retail, and this is something when we hire new people, I always really try to hammer and explain is that office is and retail are so radically different. And one of the key differentiators is this concept that in an office environment or even multifamily, it's actually really likely that there's landlord representation on site or close by. Whereas in retail or industrial, it's sometimes common for a property manager or a landlord's stakeholder to only come to the property once or twice a year, maybe quarterly. And so that dynamic is critical. And so the big driver is these assets need to be managed properly to a high standard remotely. And so the main driver is, hey, listen, ID plans fills in all the gaps and allows property managers who may be far away to have a realistic chance at managing that asset to the high standards that landlords set on their assets. Now, where we're hearing things today and why we're seeing such growth on our side is the rise of prop tech has been a double-edged sword. 10 years ago, Chris, prop tech wasn't a word, maybe even 5 years ago, I'm not sure. And there really wasn't too many huge players in the innovation space. Nobody really cared, and especially retail. Nobody really cared about retail or industrial. It was all office and multifamily. Retail was dorky. Um, and so that's rapidly changed. And it's changed in what I would describe in a very aggressive way, and the manifestation of that is that you would have a large amount of what I describe as inch wide, mile deep solutions. And what I mean by that is you have these startups who solve a very small problem, but they do it in a very deep way. And they're selling to folks like DLC or Kimco or other retailers or retail landlords. And it sounds great, but the problem is all of a sudden over a multi-year period of time, guys like DLC now have 14, 15, 16 different vendors that all are solving one problem deeply. But the problem, Chris, is that those offerings don't work well together. They're only delivering 30% of the value that the charismatic sales guy sold them. And they don't integrate with the key systems, be it MRI or Yardi or JD Edwards or even Salesforce or Microsoft CRM, these key systems. And so this becomes this huge problem. In addition to, it's very expensive. Those 14, 15 different vendors are expensive, hard to manage. Those contracts are tough. And often they get bought by private equity, raise prices dramatically, and service goes even further. So we hear people coming in droves saying, hey, we need one or two vendors, not 15. And ID plans, we have a product suite that allows folks to roll in a lot of those vendors into one platform. And Chris, it actually integrates with the key systems, like MRI, for an example, and talk to each other natively. And so that's the big driver. People need to consolidate these vendors because they're inundated with tons and tons and tons of challenges and headaches of managing all these vendors.
That is a key issue. I talk to a lot of people, and it's a great point. And a lot of people are trying to solve for this, and there's a lot of different ways people are trying to solve for it. The vendors who are inch wide and a mile deep, and I think it's a great analogy. Do they know this about themselves, and are they trying to pivot from that?
Yeah, no question. I mean, everyone realized for a long time in what we would call in tech the ZERP era, um, zero interest rate period. Not only did real estate benefit from low interest rates, as did tech companies as well. And the rise of these inch wide mile deep companies, well, their business models were kind of okay not being profitable, and they were kind of okay just, hey, we're gonna capture this very narrow vertical, and someone down the line will buy us at a 15x revenue valuation or something because profitability doesn't matter, and we can kind of solve this. We just care about growth, growth, growth. similar to the challenges that real estate's facing today with raising interest rates and harder macroeconomics. These tech solutions now need to find a more tenable way to manage and get wider adoption with their customers. And so you're seeing a rapid consolidation and rapid road mapping and product pivots to see how much wider, how much of that inch could they stretch to capture more customer wallet to insulate themselves from operational expense belt tightening, which is a huge theme right now. You're seeing guys in a lot of landlords tightening belts, trying to save cash and anticipating harder times to come.
Okay, that's really interesting. Operational belt tightening. uh,
Yeah, you'd like that.
are are you seeing an M&A like a bigger platform go? Okay, I'm a I'm a much wider breadth. Maybe you know, I'm 100 feet wide and 100 feet deep. I'm not an inch wide, a mile deep. But I like what they do, and I could use that for my customers. Let me go buy that.
Yeah, yeah, it's a huge trend. I think we've all seen. I think what really started it was probably 3 4 years ago when you saw the building engines being acquired by JLLT. I think that was big into their mix with Corrigo, and then you see the acquisition of Rafty and a few other of the interesting native innovations that they're doing, and then
I
also
think Rafty was a really good one, a good example of inch wide, mile deep.
I couldn't say it better ourselves. And I guess not to go down that road too much, but a lot of our customers come to us saying, "Well, wait a second, we're paying." And listen, Rapti did a great job, and they saw the real problem at that point in time. So this isn't about dogging Rafti, but really what it's about is our customers saying, "Wait a second, we're paying a significant premium on a per square footage basis for the solution that is really talking about all these things like procurement and managing HVAC compliance." And really, the HVAC compliance was seemingly the larger problem that our customers, at least, really more interested. So, Chris, what we did in our tenant portal, we just rolled right out the HVAC compliance that allows our customers to manage similar to sales compliance or regular COI. We're now seeing customers be able to consolidate right into our platform and get probably 70 80% of the value of a Rapti like solution for a tenth of the cost, right? And that's something that's really really exciting. But more on the consolidation and M&A side, you see VTS with their round of CBRE. You're seeing a lot of the big brokerages trying to hedge their businesses in hard times into technology and rolling up a lot of these providers.
So let's talk pricing,
Great.
because price inflation for these tech companies is getting, for the customers, is a big consideration. I think it's getting insane. And it- you know, and how prop tech companies are thinking about pricing for property owners. Like, I'll tell you, when I hear a prop tech company think about pricing and using per square foot as the denomination, I start to get really like, what does my per square foot have anything to do about pricing? How much GLA we own, anything to do about what we're paying for software? Because it has nothing to do. And so I would argue it has nothing to do with it.
Well, let's talk about, because I think if I was going to consult for any prop tech company, I think the one thing that's the quickest way for you to lose deals and not be successful is getting pricing wrong. And what we hear a lot is, as someone who talk to probably every single technology buyer in the industry. I mean, of the top 50 real estate companies, I know them, I talk to them, and I've sold to them, right? And if there's one thing that irks technology buyers is you don't understand our business. Number one, and number two, you don't appreciate the scale. The GLA thing, I think, is inherently flawed in some senses in a pure software perspective, because you're right. It's trying to correlate storage hosting to square footage is
That's
probably
my point. That's my point. That's
right.
my point. And a lot of prop tech companies are trying to price that way. And it's really, I'm like, why? Why?
I'll
Like,
tell you.
because
I,
they don't know how, they can't figure out how to price it.
Right. And so, Chris, that's why we price on a per property basis. And I'll tell you why. Now, you may be thinking, well, wait a second, Jordan, it isn't a proper just an aggregation of GLA. It isn't, it isn't. We want to adjust. So there's not a perfect model here, right? How we think about it is this. We need to honor scale, meaning that the more square footage we have, the better we can discount, right, on per square footage basis, right? I mean, the larger portfolios obviously going to be more competitive from a pricing perspective. But also, we have to handle things like disposition. These assets are bought and sold all the time. And so we have to have a model that allows us to pivot to let's talk about DLC. If DLC goes on a buying spree and adds 30% to the portfolio, acquires, let's say, 20 more assets. Well, we need a model that allows us to go up and down to accommodate. And the same thing in reverse. I mean, if you guys sell a whole bunch of properties, we want a model that's able to accommodate. We don't want to punish you for your acquisition and disposition processes. We want to grow and contract with you, not necessarily be a deterrence of either of those things.
So if I sell sandwiches, okay, what I say is my cost is X, right? This is my labor, my shipping, my food cost. My cost is X. Here's the margin I want to make. This is how I'm going to price it. Let's see if the market responds. And
Spoken like a true real estate guy.
what, like that's instead we're making these things like, oh, let's see. I have a software that sits in the cloud, and we're not going to talk about what my cost is to operate, what my labor is. What we're going to talk about is how much do these guys know? How much do I think I can get them to pay from, and how do I make that in a language that they can understand? Because, oh, they all talk square footage, so let's put it in square footage. And so people have been selling sandwiches for a long, long time and profitably. And obviously the software industry is supposed to be one of the most profitable places. And that's why people move to tech. And so they're trying to reinvent pricing. But I look at, and my sandwich example is silly. I understand, but you get my point when I say that, right? It has one of the things that I think on the proptech side that's happened, especially most proptech doesn't have leverage that some other tech industries have over the customers. I'm surprised that pricing is going to, let's see how much they can afford to pay and apply a denomination that they can understand to get to back into that price versus saying, here's my cost, here's the margin I'm going to make, sell that like other industries do. And unfortunately, the sandwich space is a lot more competitive, and therefore they're forced to do it that way. And maybe that's the issue. But
Yeah, for sure. I mean, listen, I think drawing comparisons to two, I think it's worth the conversation, and I think we've hashed this out before, Chris, for sure, offline. What I would like to say is it's really not exploitive. I'd say technology is a little bit different in that we are scored in a little bit of a different way. There's tons and tons of engineers and costs and things. We're squeezed on our end as well, just like you are. And our pricing, how I can speak for us. We think about pricing not from a hey, what can we get? From how much value are we giving, and how can we make it just make sense for our customers? Be it from optimizing for recoverability, be it optimizing for in a way that works with their model, right? And inherently, um, it, it forces us to be competitive, right? I mean, it is getting more and more competitive, and I think you're seeing there's some corrections from pricing that are coming, and you're seeing a lot of folks like ID Plans who have a service component, which I think exempts us. Maybe that gives us a hall pass, Chris, because we do have our field groups, which is a heavy cost to the company, but adds tons of value. I think we may get a hall pass from your.
yes, I'm not knocking ID Plans. I'm
No, I love it.
challenging the pricing of of software and its application to real
It's
estate.
inherently abstract. It's inherently
So
for sure.
it's abstract, right? Whereas when I would say, like, pre-pandemic, I was getting a cold call from a software provider weekly. And as you said, they were all inch wide, mile deep. But here's the thing. Some of them had to do with proptech. Some of them weren't proptech. They were just software solutions. Here's what fascinated me. They knew enough about our company. They were all the same price, no matter what they did. All of them, all the same price. I must lose hundreds. They were all the same price. So there's a playbook out there. I don't know where it is. There's a play. They were all the same price. And I was like, how could that be? A bowl of cereal is not the same price as a burrito.
That's
They're
right.
all the same price because they were basing it on what they were making an assumption. And it could have been the other way. So maybe I can afford it more. They're making an assumption of what I can afford to pay versus how some other industries are pricing.
For sure. Well, listen, it's certainly an art, and if there's one
It's
thing
art.
that something a company can do well, it is pricing. And
100%.
I always applaud as a buyer and a seller of software. I always applaud transparency, and I always applaud folks that spend the time to understand the nuances and the limits of our business. And we try to do that too. We try to be as empathetic as possible in how we structure things in a way. And I
So
think that
one of the things that I think as technology companies start to like really dig into real estate is one of the words that we use all the time. It's not just square footage, it's what is market? What is market? And I
sure.
think, and right, what is the market rate? What is the market cap rate? And we use these terms and we're very used to what market is. And I think if you were to ask that question to a software provider, what is market for this product? Their answer would be, we're special. Their answer would be, well, this is a different product. I'm not like anybody else. We're special. So it's right. And listen, real estate people try to do this. Oh, this piece of real estate is different than that piece of real estate. And
Right.
it always comes down to what is market. And in software, it's like, we're unique. We're different than this product. And we are, and this product, and they don't do this. And so it's like, there's no market.
Chris, I think we should be careful here. I don't want to talk so loud and give any more attention to CoStar to jump into the software business. We don't want CoStar to be analyzing and calling people and pulling market prices on proptech now. We certainly don't want that.
Oh man. But I think that's one of the challenges software has with real estate is real estate people inherently are used to this concept of what is market,
Right.
right? What is market, right? And I think that's one of the challenges. Anyway, we
No
spent
question.
too long on pricing.
I think it's cool.
uh, so you have this issue, right? That's issue one that your consumers are talking about, which is inch wide, mile deep centralization. Issue two, always pricing.
Yep.
What other issues are customers talking or you hearing about and trends you're hearing about that either you're trying to solve to or you believe that I can plan to solve them to or you want to in the future?
Man, it seems like, especially in these days, there's never a shortage of problems. It seems I talk to people every day. I mean, on the buy side, on the sell side, managers, leasing folks. If I'm talking to a broker right now, which I try to spend a lot of time because I think talking with leasing folks is sort of the spark plug of the industry. I think it's like if you really want to understand the industry, looking from a leasing perspective, I think is more interesting to me. At least that's how I early on got there. And today you're looking at the big problem is occupancy is so high. The lack of vacancy is becoming incredibly frustrating for a lot of deal makers. And when you have spaces, apparently, when I talk to brokers, they talk about folks like these larger REITs or larger retailers who are sitting on LOIs for an extended period of time because, well, they kind of have their pick of the litter. And I think that's one of the big problems that we want to help with organizing that information in a way to help when you have a prospect, how quickly can we close? The concept of time killing deals, in my opinion, it can't be more clear than today. If you are, we want to be able to respond quickly and accurately more than ever with some of our products and offerings to ensure that when brokers and deal makers have an opportunity, they can jump on it immediately and quickly and really try to shake out the landmines first. So we spent a lot of time talking about our ID360 products, which is that space profile piece that gives all the information needed to really get to that LOI, and our tenant portal, where we're able to really visualize the entire horizontal path of a deal inside our tenant portal to really help grease the skids for sure.
So as it relates to the problem you talk about, I think so. Supply and demand, we talk about a lot on the show, which is occupancy is high. I, I think those fundamentals, I think it depends on who you ask if that's a problem, right? A retailer who's looking for space in the market, maybe that's a challenge for them. A broker who it only makes a living if a transaction happens. That's the potential. A new transaction is a problem for them. On the landlord side, it's clearly an opportunity today,
For sure.
right? As an owner, and it's an opportunity to get to a place where you can, landlords have been in this position for over a decade, where actual rent growth has been a real challenge. Net effective rent growth has been a challenge. We're now in a position where potentially you're seeing that, and we've been in a place for 10 years where it's been limited. And so this is clearly a landlord's time to shine, to drive NOI properties where it's been challenging to have that same store net accretive NOI growth. You could always buy a deal, but is that net accretive?
Of course.
And now you're starting to see landlords have that ability. And I think there's some opportunity in that versus it just being a problem.
Totally agree, and I think on that in some sense, anecdotally talking to folks on the landlord side who are choosing not to renew 2/3 of their spaces, right? Meaning that they're willing to go in the market, they're willing to test the market, they're willing to prioritize a proper curation of the shopping center. Meaning, how are we able to create a really a good continuity or really complementary tenant. Really look at the voids, really trying to stay competitive. And landlord, it's certainly not free for the landlords for sure, but specifically the brokers, we are super sympathetic to the challenges on the retail side. But you're totally right. I will want to pick your brain a little bit on not to get too nerdy or too financial, but I do think it's interesting about how TI is affecting today because you said something interesting where you can always buy up NOI, right? You can always buy rent. And what you mean by that is, hey, I can really inject a lot of capital into the space, into the opportunity to entice a higher rent, which that's a that's a great strategy and works all the time. Now you're in the scenario to where with a higher supply of potential tenants, how does that affect your thinking of how you're allocating TI? I think that's something that I'd be curious to learn more about.
So I think the a couple of things. So generally speaking, the there is, I'll call it the cost to install a tenant. That could be tenant allowance, landlord work, architecture fees, broker fees, legal fees, whatever your cost is to install a tenant. It has, over since 2007, it's really grown. And one of the reasons that grew wasn't just inflation. And I'd say that it grew for the landlords was pre 2007. There was uh, the balance of those costs were more evenly distributed between tenant and landlord. And to get deals done between 2008 and 2019, if your landlord wanted to get a deal done, they had to take a larger percentage of that cost to get the tenant installed. Post-COVID, those costs rose from inflation, primarily the construction cost. But so that's made everyone have to get more creative to make a deal. But I would say, generally speaking, the pendulum is shifting because of a lack of supply, where you said the landlords are getting to choose what they want to do. And I would say that, generally speaking, deals are incrementally, not all at once. It's not all at one shift, and it depends on the property. Incrementally, that balance in capital going into the space is starting to get more evenly distributed. And
Mm.
so that, to me, when we're looking at it, it's on a case by case basis, but we're cognizant of, on a blended average, can we continue to bring that capital back to a more balanced place that it once was, that it once was than it is today. And that is starting to shift for everybody. And there are some retailers who are out there who are making deals where they're taking on the full burden. Now they want it, I mean, in construction. And what they're doing is they're saying to the landlords, we want a lower rent for it. We'll take on this high capital, because there's a lot of retailers sitting with a significant amount of cash on their balance sheets from COVID
Mm.
and looking for the best place to put that to work. You could buy back stock, but if you think about it, one of the best places they generate return is by stores. So let's put it into the
Right.
stores. And at the same time, they might be able to lock in lower occupancy costs than they would otherwise, because they put that capital to work. So there
That's
are
right.
some retailers that are doing that. Not all retailers. There are other retailers who still want the landlord's money. They'll pay a higher rent. They have the credit to do it, but they want to grow so fast that they need the capital required is insane. And you look at, you look at some retailers who do that. Some big national chain QSRs do that when they want to grow like hundreds a year. So I think that balance is shifting. And I think most importantly, right, over the last few years, the foundations that like don't even hit the numbers in the data that comes out of commercial real estate that I think is interesting is, so there's all these new tenants that opened. So you've got fresh new tenants. Some of, when I say fresh, it doesn't mean they're like new first concept, meaning new tenants to properties. They're the ones that were the strongest coming out of the pandemic. Landlords and retailers have deployed significant capital into stores and real estate. So that's good for the experience, for just the physical infrastructure of the properties, right? And we've put the properties in a much better place than they were financially, physically, credit, and tenancy wise. So you have higher occupancies, you have better credit, you have higher, you have deferred maintenance taken care of, new capital, and less vacancies. So I think this has made the foundation of the real estate much stronger, and is putting the landlords in a position to now be proactive and offensive, to focus on things that maybe in a 2008 it was like, this tenant's leaving, this tenant's leaving, how do I backfill this space? Where it's like, okay, let's take a look at this property. Where does this property need to go in 10 years? How do I drive it that way versus being reactive? I think that's a snowball effect that's continued to be better for these properties long term.
That's there's a lot there. I think it's interesting, and I think I agree with everything you say, and I think that like totally makes sense. I guess the other view from a landlord perspective, the more cynical view would be from a leverage perspective. We talk about cost of debt, and we talk about the value add strategy. We talk about these construction loans coming due, and when you pencil a deal in 2019, expecting a certain cash out, expecting certain interest rates to be somewhere, and all of a sudden now they're not.
Yeah. So
Um,
I think So that's the foundation at the property level I'm speaking to. I think the financing of properties is challenging. In particular, new development is super challenging right now. That's really it, right? If you have existing improved land, you're in a much better spot. And one of the reasons we have lack of supply is it's really hard to develop right now. And a lot of development deals are open book where you go to a tenant and you say, and maybe this will be good for you when we talk about price. There's a lot of deals in development that are open book where the landlord said, here's my costs.
Yep.
Here's what I need in rent to pay for my costs and make a little bit of money if we do a development deal. And a lot of development deals are done that way. That spread is super tight today. And where there's a lot of development is and driven by the cost of the capital to do the deal. And a lot of development deals that aren't moving forward right now and forcing retailers to look at existing real estate.
Exactly right. Which is on the buy side creates even more challenges. It seems like this is a big cycle, right? Land building net new is incredibly expensive and hard, which makes the supply constrained, which creates
I would say I would say to that, I want to pause you. It is I think there's a bit of a unique cycle. Typically, when the price of real estate goes down from a sale price, it's usually correlating with tenant demand. Right now, tenant demand is going through the roof as price of real estate is coming down. That is rare, more rare than the opposite. So I'd say it's a tad unique of a cycle. Being in a high interest rate environment is not necessarily unique, except for the last 10 years, we've been in much higher interest rates than this. What I would say is unique is the level of tenant demand, given the capital market disruption, is a unique cycle.
so yeah, very interesting, and I definitely agree. It seems counter to where demand is being high, and you see some correction from a pricing perspective. I think some people would say, well, COVID just created such a demand for on the acquisition side that just drove up pricing on real estate so high. We're seeing a simultaneous correction from that inflated pricing from post COVID or from COVID times to while simultaneously seeing strong retail demand. Let me ask you a question from a fun perspective and from an action perspective. Again, sorry to get too nerdy here, but I think it's exciting. You see the headlines: commercial real estate collapsing, commercial real estate dying, and really, you look at office. How do you think that affects retail commercial real estate, or does it at all? Do those headlines affect your guys' thinking or how you guys handle your business?
I'd say the way I would answer that, and the way I would answer that is, I think headline news impacts business every day. Period. End of story. It does. Um, Headline news impacts business. Like a news article comes out and the stock market moves, right? So headline news moves business. It just does. So to me, it's about when that happens, are you able to take advantage of the opportunity or not? All right.
Sure.
We're running short on time. I want to ask you one more question.
Shoot.
Let's stay away from artificial intelligence because everyone's talking about it. When we look at the prop tech world 5 years from now, as a consumer of it, what should we expect?
Well, not talking about AI, because obviously I think there is a place for that for
You can
sure.
talk about it. I'm just kidding. I was kidding. You can talk
Well,
about it.
no, I agree, and listen, I think be it machine learning or generative AI and all these sorts of things, it's going to have a role for sure. But I think people can. It's right. It's changing so quick. I don't want to be clipped 3 years from now. To being proven wrong so quickly. But what I'll say is this: I think you're going to see a continuance of consolidation. I think software modeling and how software companies who niched in prop tech raise money in front of their business isn't going to go back soon. I think every operator of a startup is going to continue to um, change their models to be more traditionally business focused. So I think you're going to start seeing buyers have more power, and I think you're going to see more consolidation into some of the larger organizations who are trying to create this ecosystem that's really end to end, right? A true end to end system for commercial real estate. Also, another interesting thing, a trend that I'm seeing guys, industry guys, write angel checks into startups. I mean, you're seeing it all the time. You're seeing folks and deal makers, people in the industry who are partnering with a lot of these startups and helping fund them and becoming strategic advisors. I think you're going to see tons of that. I think you're going to see tons of commercial real estate guys move in and write angel checks into these startups, and I think you're going to see, which is a good thing, by the way. I think you're going to see a that knowledge gap between product engineering and the industry. I think is going to be shortened. I think you're going to see product guys get smarter about the industry and start really solving more problems. I think I have no reason to be not to be optimistic. At ID Plans, that's what we're focusing on all the time. We're learning, we're iterating, and we're trying to ensure that we're solving the right problem. And I expect our competitors and our colleagues in the industry to continue to do the same thing.
Uh, I the point that you got in there, that the software platforms are going to start to operate more like traditional businesses. I think that's interesting, and I think I'll end on that note. And Jordan, thanks for coming on. This was really great. Really appreciate the time.
Chris, thank you, sir.
Appreciate you watching. Hit subscribe. See you in the next one.